Okay, y'all on? All right, so we're learning about long-term liabilities. So remember, the balance sheet has assets, it has liabilities, and it's gonna have the equity section. So we went through the assets, the long-term assets, and then last week was current liabilities. This week, we're gonna do long-term liabilities. We're pretty much gonna focus on one thing, is bonds. We do have long-term notes payable, which is very similar to how we calculated the short-term like notes payable that we've talked about in the past when we're looking at that we're setting up some money that we're borrowing and we have interest. So we'll look at one of the homework assignments and we'll go over it, but it's pretty simple. It's not a lot to it. What I want to focus on is the bonds because they can be a little bit confusing. So who has heard of companies issuing bonds? You heard of that? Why do you think why did they do that? Do you know? Right, raise capital. They may have a project and they're looking to get some money in so they can build, let's say it's a new plant. Well, there's a couple of options. You can go and you can get the money from the bank. If you do that, then there's certain requirements. They may require you to turn in reporting quarterly. They may require you, to pay interest higher than maybe what you can pay out on the bonds. So they also will be doing lots of calculations and, you have to stay at a certain level of activity in the business. And maybe you don't want to get into that. Maybe you don't want to go through all the process of borrowing the money from the bank. So one of the things you can do is raise money through bonds. So you would, go on, say that I'm going to sell these bonds for a certain amount of money, and I'm going to pay you interest. So over the life of the bonds, if you buy a bond that's 10 years, and the organization tells you, we're going to pay you semi-annually 8%. Well, then every 6 months, you're going to be issued a check. So you'll have that money coming in. So you're investing and giving them the money up front. You'll get that money back in 10 years or 2 years or 5 years, whatever the bond is, you'll get the money back. But along the way, you're going to be earning interest. Okay, so they're going to pay you out. What we're going to look at are some examples of that process. What does it look like? We'll look at some simple versions of it. And then we're going to get on Connect and do some of the homework problems because there's tables on there. I want to make sure you understand. Sometimes they use the present value tables instead of just telling you a percentage. We have that in there for homework just to expose you to it. But on the test, we won't have tables to look up or anything. I'll tell you how you have to know the material for the test. So the bonds is basically your financing. You're getting some money up front and you're going to use that for some maybe capital expense or something like that. There's the echo again. Oh, that was your volume. Okay, I thought maybe something was going on up here again. Okay, so let's walk through. And I think I might just kind of tell you what we're going to do and then we'll look at them individually. So the bond has a par value. So that's just face value or par value, same thing. Can use it interchangeably. The par value of the bond is basically the face value. And that is always going to be recorded at face value. Sometimes you sell it exactly for what the face value is. So if it's, $100 bond, you get $100. It's face value. Other times, you may sell it for a premium or you may sell it for a discount, depending. So we're going to walk through all of those different scenarios. The easiest, obviously, is if you sell it for the face value and how you record it on the books. So I want to look at how we're going to record the actual, when we issue the bonds, we get the money in, how do we record that on our books? And then what does it look like when we have to pay the interest out? So we'll only do one because every 6 months it's going to be that same entry. And then we'll look at in the end, when we pay the money back out, what does that look like? We're going to walk through it for par value, we'll walk through it for discount, and we'll walk through it for premium. Okay. All right, so what are some of the advantages to doing that? Some of the advantages, we have to issue in the bonds instead of getting a long-term notes payable or something else, maybe issue in stock. It's a couple of things you can do to raise the money. But what are the advantages of the bonds? So they don't affect the control, right? So we're in control still. We don't have anybody else coming in. If you sell stock, you have other owners coming in, and that might, mess up your plans. So you don't want to do that. So that's an advantage. Then you have your interest that you're paying out. Your interest is tax deductible. And then they can increase the return on equity. So depending, if your money's earning more money than you're actually paying out in interest, that's good. Could be the reverse though. That's one of the disadvantages. So it could decrease your return on equity. And then what is another disadvantage? So they require you to pay both principal and interest. So we're going to have to make that commitment that we're going to have that cash flow we need in order to continue to pay those interest payments for the life of the bond, and then have the money in the end in order to pay that money back. So if I'm developing a new plant, I'm going to be paying that back out after the plant's been built. I've used that money, and now I've started producing, and I'm bringing in extra income. So I have extra revenue coming in, I have extra profits, and that money is going to get saved in order to repay those bonds. Okay, so let's look at one that we sell at par value. So on December 31, 2020, a company issues a bond. Its par value is $100,000. The interest is 8%. We have the semi-annual payments. The interest dates are 6/30 and 12/31 with a maturity date of December 31, 2022. So we have 2-year bonds. It's $100,000. So what happens when I issue the bonds? So I'm going to trade. I'm going to get cash in, and I'm going to issue a certificate of the bond to the investor. Okay, so when I bring the cash in, now I have to record that on my books, right? I'm also liable to pay them in the future. So I have to make sure I set up that liability. So we're going to call it bonds payable. When we do the journal entry, cash is coming in. Since cash is coming in, that's our debit to cash. It's an asset account, right? So we put it on the books for $100,000. That's what we're collecting. We're selling them at par value. Base value is $100,000. So when I say that we sell them at par value, that means the $100,000 is exactly what we're getting in cash. That's why we're recording cash at $100,000. We have a bond payable of $100,000 that we have to pay back in 2 years. So we're going to set that up, and it stays there for the life of the bond. Okay, does that make sense? So now we're at June 30th of 2021. So we have to issue our first interest payment. Well, it told us that the interest was going to be 8%. So we're going to take $100,000 times it by 8%. And I'm paying it not once, right? The 8% is an annual rate. I'm not paying it once, I'm paying it twice. So that's why I'm multiplying it by a half. Okay, so we have $8,000 we're gonna pay out a year, just divide it in half because we have 2 payments going out, so it's $4,000. That's the interest payment that I'm gonna make to who invested and bought a bond. So now I need to set up that journal entry in order to issue the payment of the interest. So on June 30th, I'm going to have a debit, which is an expense account, right? It's going to go to my income statement. It's going to reduce my income because that's an expense now. It's bond interest expense for $4,000. And then I'm crediting my cash because I'm cutting checks out and I'm sending the $4,000 out. So every time it's time for an interest payment, that's the entry we're going to do. We're going to cut that check out, code it to interest expense. The reason why we're calling it bond interest expense is more than likely on their chart of accounts, you'll see multiple accounts for interest. So you may just have, may have three. So one could be your mortgage interest, that's an expense. One could be your bond interest expense. One's just regular interest expense for any other little thing that you have. So we want to label it bond interest expense to identify this expense for interest is for the bonds. Okay, so June 30th, 12/31 of 2021, we make that entry, we make the payment. Notice we're not doing anything with the 100,000. Okay, the 100,000 is what we sold. We recorded it when we issued it, and then we don't touch the bond payable account at all. The interest that we're sending out is just interest. We're calculating it out. We're going to do a debit to interest expense and then credit cash. So we'll have 4 payments like that. We'll have 2 in the year 2021, and we'll have 2 in the year 2022. At the end, December 31, 2022, now it's time that, the bonds are up. Its maturity date is 12/31. So now I have to pay that money out. So when I go to pay it at maturity, now I'm going to get rid of that liability that's on the account. A liability sits as a normal what? Credit balance. So if I have a credit for $100,000 for a bond payable and I need to get rid of it, what am I going to do on my journal entry? Debit. So in order to wipe it out, I do a debit to bond payable, and then I credit the cash because that's what's going out. Yep, you just reverse it. So what's happening, I issue the bonds, I get it on the books, it sits as a liability, and it just stays there. We don't touch it till maturity, unless we do a call and we get rid of it early. But we're going to wait until maturity, and we'll do an entry. And at that point is when we're going to wipe out the whole thing. And it's only for the base value that we initially set up. So it seems pretty simple, right? So you have the issuance of the bond, putting the bonds payable on, getting the cash, and you have the maturity where you're paying it back out. So it's just reverse. Paying the cash out, bond payable gets debited, and it goes away. Then I have the in-between where I'm paying interest. And that calculation is take the base value, multiply it by the interest rate, and if it's semi-annual, you're going to multiply by the half because you're paying it out twice a year. Okay, so that one's fairly simple. It gets a little bit clunky when we look at bonds, discounts, and premiums because there's something else that we have to keep track of. So first we just had the face value, and we put that liability on the books, and it just sits. We have the interest for the payments that we have to go out as an expense, and that's it when you do face value. Now when we sell as a discount, there's going to be another layer in there that we have to keep track of, something else, which is the discount that we issue. All right, so let's look at an example. So notice the note in red, it says contract rate is below the market value, market rate. So you'll have a market rate on interest, and then you have what you're going to pay out on interest. So if I'm going to pay below the market, then I'm going to have to issue that bond below the face value in order to get someone to invest. So their interest isn't going to be as much as maybe something else because the market value is higher. So I have to sell it at a discount in order to get people to invest. So the example says you have that same $100,000 par value. That's our face value of the bond that we're issuing, 100,000. So our issuing price is 96.40%. So we're not getting 100% of the money. Log into the Zoom in order to see, because I forgot my adapter and I can't show it on the screen. So I'm not getting 100% of the money. I'm selling it at a discount, which means I'm not going to get the full amount. When we buy something on discount, do we pay full amount? No, so that's a good way to remember. If I'm going to get a discount, I'm paying less. So when you're doing your calculations for homework and on the test, remember that what I'm looking at should be what I'm saying the cash coming in, it should be less than that face value. So I'm saying I'm going to get 96.4% of par value. The stated interest rate is 8%. So that's what I'm willing to pay for interest as I go through the 2 years. The market rate is 10%. So see, I'm paying less than what the market rate is. And then the interest dates are the same, 6/30, 12/31. We're going to pay twice a year. We have our bond date of December 31, 2019, maturity date December 31, 2021. So we have 2 years again. Okay, so now it changes when I have to do my journal entry from when I issue the bonds. So how much cash am I getting? I'm getting 96.4%. So I can do 100,000 times the 0.9640. So the cash that I'm bringing in is 96,400. I'm not bringing the full amount in. So I can calculate how much am I getting? And I know that's my cash entry. Cash is coming in, so we're going to debit cash for 96.4. I need to figure out what was my discount. Well, if I don't collect the whole amount, the difference is the discount that I gave. I need to keep track of that. And over time, I'm going to expense a portion of that. So how do I calculate that? So the 100,000 less than 96.4 is your 3,600 for your discount. Okay, so now I know my cash coming in is 96.4. The difference to 3,600, I'm going to have to debit that to an account that I'm going to expense over a period of time. I'm going to amortize it. I'm not going to expense it right now. I want to set it up to expense over time. So the account is going to be discount on bond payable as a debit. So it's a contra liability account. It's going in the opposite direction of what we normally do, right? Normally a liability is 3,600. I'm not going to have to pay that to anybody. I'm not liable to pay that 3,600 to anybody, but it is an expense to me. Why? Because I didn't get all the cash up front. I only got 96.4. So I have to expense that 36 over a period of time. So it's going to be a debit to a payable account. And then the bonds payable that we're crediting that we have to pay back out at maturity is $100,000. And why is that? Because the base value of that bond is 100,000. And that's what I need to set it up for, because that's what I'm gonna pay out. Okay, so you're an investor, pay less than the 100,000, and then you're gonna get back the 100,000. And then you're gonna interest in between. So, all right, so let's walk through it. So on my bond issue date, that's gonna be my entry. Debit cash, 96.4. Debit discount on bonds payable, 3,600. Credit bonds payable for 100,000. The bonds payable should always be the face value. Okay, so now I want to pay interest. I guess before I do that, let me just make a note. Okay, so on the balance sheet, when you're looking at the liability section for long-term liabilities, you'll see bonds payable 100,000, and then you're going to see less the discounts on bonds payable for 3,600. Okay, so you're going to have a net value, carrying value of 96.4. What's going to happen over time as I expense that discount over the period of the life of the bonds is that carrying value is going to go from 96.4, and it's going to increase each time I make a payment up to the 100,000. Okay, our carrying value. So you're not going to have it in your bond payable account. It's just the carrying value. So you have the 100,000, and then you have the 3,600, and net value is the 96.4. So as we chip away at that discount, eventually you're not going to have the discount on there anymore to take it away. So your carrying value is going to continue to increase to that 100,000. I know that sounds a little bit confusing, but if you look at it the day you issue it, it's going to have a carrying value for what the cash is that you received. Now, when we calculate the interest payment, we have to do two things. We're still going to calculate the interest exactly the same way as we did on par value. We have the 100,000 times 8% times half, which is 4,000, because I know that's the interest that I have to pay out. So I'm going to code that to interest, bond payable interest, bond interest payable, and it's going to be the $4,000. But now, because I gave a discount, I also want to expense a portion of what that discount was. So that is going to be called straight line, is what we're going to use, where we try to figure out how much is it going to be for each one of these payments. So 3,600 is what we're going to divide evenly over the 4 payments. Okay, so we have 4 payments, and that's why we're going to divide by 4. So we have 3,600 divided by 4 to come up with the $900. So not only do I have to expense my interest, but now, because I gave them a discount, I want to expense a portion of that 3,600, which is 900. So every time I make a payment, my interest expense is now going to be 4,900, not just 4,000. So I'm going to expense the portion that I'm going to pay out, which is the interest. I'm also expensing the amortization of the discount. So 900. So debit bond interest expense, 4,900. And then I'm going to credit discounts on bond payable. Remember the initial entry. The initial entry was a debit to discount on bonds payable for 3,600. Well, I need to reduce that over the course of paying those 4 payments of interest. I'm going to reduce it. So now, instead of 3,600, it's going to be 3,600 less than 900, because I'm putting a credit into discount on bonds payable for the $900. And then I'm crediting cash for 4,000. So you see, the payment going to the investor is still only the interest, which is $4,000. But I am expensing not only the 4,000, but the portion of the discount, which is 900.
So the discount
I'm
goes.
not. Go ahead.
So the discount is actually counted as income towards the bond, right?
No, it's not counted as income.
So like if I were to get a bond and I got a discount, that discount wouldn't be extra money from me?
Yes, if you're the investor, but we're not looking at the entries from the investor standpoint. We're looking at the entries from the organization. So it's an expense to the organization.
Now, when you say investor, like, so the company, if I worked for the company, and I would be the investor.
Well, if you bought it, you would be the investor. We're not looking at it from that point of view. We're looking at it from the organization's point of view, where they are getting money, they're borrowing the money. And so they have interest they have to pay out because they're borrowing money. That's an expense. We also issued on a discount. And so that's extra expense on our part, because we're not getting that $3,600.
Somebody needs to mute their speaker, because I hear a bunch of music.
Does that make sense? So far, y'all with me?
Yes, ma'am.
Okay. So when we make the payment, we're making it for what? Just the interest to the investor, correct? How do we calculate that? We know that the example told us that the stated interest on that bond is 8%. So it's giving me the market rate. Am I paying the market rate? No. I'm paying the stated rate, which is the 8%. Okay, so I'll put on here the table. So as you go through making the entries, each time you pay the interest out, you're gonna expense the interest and you're gonna expense a portion of the discount. Remember that? So we had unamortized discount that we started with of $3,600. Once we make the first interest payment on 6/30, we're reducing it by $900. Where'd the 900 come from? Remember, we're making 4 payments. We're doing straight lines. So we're just saying, okay, so I want it to be even. Every payment that I make in interest, I want to expense a portion of that discount. So we divide it by 4. That's where the 900 came from. So I have 3,600. And then remember, I did that credit to the account. So what happens to my account? It goes down because I did the opposite. So I'm sitting with a debit of 3,600. I credit 900. So now my balance is 2,700 as a debit. Then when I make a payment on December 31, it goes down another $900. I make a payment on June 30 of the next year. It decreases again to $900. And then the last payment that I make on December 31, when I pay interest, I'm going to also expense that discounted portion, $900. So now the discount, that account that was called the discount on bonds payable account, went from 3,600 all the way down to 0. So now when you look at the balance sheet and you look at the liability section, now you'll just have bonds payable for $100,000 because we have expensed 900 4 times when we made those payments. So now that is gone. So there's nothing reducing it. So now on my books, all I have left at the end, the maturity date, is the bond payable for $100,000. I've expensed all of the discount already. Okay, so when I make the payment, what happens when I make the payment? It's going to look just like this entry. I'm paying the bond at maturity. I need to remove it off my books. A liability's normal balance is a credit. That's how we set it up. So I'm going to debit bonds payable 100,000, and I'm going to credit cash 100,000. So it's the same exact entry when I'm paying the bond back. The difference is how we set it up, because remember, the cash coming in isn't the full amount. So I have to make sure that I debit that bonds discount on bonds payable account for the full discount. And then I reduce that as I go through the payments through the term of the bond. And then at the end, it's gone, and I've expensed the whole thing over that period of time. Okay, so that's bond discount. Do y'all have any questions on that? Okay, so keep in mind, we sold it for a discount, so we didn't get as much money. And that's why we had this added money that we didn't collect as an expense. Okay, and that's why our interest expense went up, because we wanted to expense it over a period of time. Now,
I was gonna ask real quick, for the discount, what made you divide by 4 again?
the reason why we divided by 4 is because you're asking why we divided by 4, or what are we dividing by 4?
Yeah, why?
Why? Okay. So the difference between what we collected and what we received, we only received 96.4% of face value. So we got 96,400. That difference of $3,600 we did not collect. We want to expense it. And the bond is a 2-year bond. I'm paying it twice a year. So how many payments am I making? I'm making 2 in the first year, 2 in the second year. So I have 4 payments. I want to do a straight line amortization of that expense. That's where the 4 comes from. Okay, and then I take the 3,600, I divide it by 4. So I'm saying, okay, I have 4 payments of interest. I want to expense this over a period of 4 payments, so evenly. And so I divide by 4 and get 900. So that's determining me on the amount that I need in order to expense evenly over the course of the bonds, over the life of the bonds. Does that make sense?
Yeah.
Okay, so we're going to use the same example, but we're going to look at it as a premium. All right, so look in red, it says that the contract rate is above the market rate. So now we're flipping it. I'm going to issue this bond and I'm willing to pay more interest than the market rate interest. So I'm selling it at a premium, which means I'm going to get more than the face value. But I'm going to pay you more interest in the 2 years. So you're willing to pay a little more because the investors are willing to pay a little more because they're going to get more interest. So we have a par value of 100,000 again. We're issuing it at 103.6% of the par value. My rate is 12%. Market rate is 10%. Interest is paid on 6/30 and 12/31. So we're looking at 2 payments again for the year. And then we have a bond date of December 31, 2019, maturity date December 31, 2022. So it's a 2-year bond. Same exact example, but now we're flipping it. We're getting more for the bond because we're selling it at a premium. We're going to give them more interest than the market rate. So when we calculate the interest, are we using the stated rate or the market rate? Stated rate. So we're going to pay the interest more, the higher amount, which is 12% in this example. Okay, so let's look what happens when we receive the money. So remember, we're selling it at 103.6%. So we're going to receive 103,600. So we're receiving $3,600 more than the face value. I have to record it that way because that's the cash that I'm going to receive. I'm receiving the cash of 103.6, so that's what I'm going to use for my entry for cash. So debit cash for the full amount that I receive in cash. Okay, what's one other thing that we know? That I'm going to put a bond payable on the books at face value. What's the face value? It tells me my par value is 100,000. So I know that I'm crediting my bonds payable for $100,000, but I received $3,600 more and my entry is not in balance. So now I need to know, where do I put that difference between what I actually received and what the face value of the bond is? So now I have to figure out, okay, where does this $3,600 go? If I got $3,600 less, it goes to discount on bond payable as a debit. If I get more money, then I have to credit. You want your journal entry to be in balance. It's got to be equal on the debit side, equal on the credit side. So my account's going to be called premium on bonds payable. So we have discount on bonds payable and we have premium on bonds payable. Premium on bonds payable is going to get a credit, $3,600. So now my entry is in balance. And that's all I need to do when I issue the bonds. That bonds payable of $100,000, it stays in that account, just like when we sell it for par value, it just stays there until the end of the 2 years when it matures, and we have to pay it back out, and we'll remove the 100,000 and we'll pay that 100,000. We're not going to pay the 103.6. We're going to pay out the 100,000. Okay, so when the investor purchases, they pay the 103,600. And then when they get paid in the end, when it matures, they only get 100. So you see how that is. However, during the period of the 2 years, they're getting 4 interest payments at an interest rate that's higher than market rate. Okay. All right, so if we look at this on the balance sheet under the liability section, we'll have the bonds payable at 100. And we have to add, I forgot to change the word here. It's supposed to be premium. We have to add the premium. That's what happens when you try to copy paste. Do y'all see those little things spinning around? I guess, is that the
Yeah.
internet?
Yeah, I was wondering what that was.
I guess it's the internet. Okay, so we're gonna add the premium on bonds payable of 3,600. So my carrying value is 103,600 on my balance sheet. Now, as I go through, just like I did on my discount, the discounter had to expense that money that I didn't get. So it added to my interest. So instead of having interest of 4,000, I had interest of 4,900 because I didn't get the 3,600. And so I wanted to write that off as an expense. In this case, it's the opposite. I have the $3,600 in excess. So now I can use that money to reduce my expense and clear my premium. So instead of having to have an expense of $4,000 for every interest payment, now I can reduce that by whatever the amount is divided by the number of payments it's going to be, because I'm doing straight line. So again, we with the 3,600, we have 4 payments over the life of the bonds. So I take the 3,600 divided by 4 and I have $900. But instead of expensing that in addition to, now I can reduce the $4,000 interest. Right? So let's calculate the interest. So we're gonna have the interest less the premium. All right, so we had 100,000 times 12% times half, because we have 2 payments for the year. So the interest that we have to pay out each time is $6,000. When I set my entry up, I do not have to expense the entire $6,000. I'm going to reduce it by the 900. So instead of expensing in my bond interest expense, instead of having $6,000 there, now I'm going to have $5,100. So you see how that is? I got a little extra money in the front, and I'm going to take that money and I'm going to help reduce the interest over time that I'm paying out in extra interest over the market rate. And the discount, it's the opposite. I didn't get the money, so I want to add it to the interest payment and just write it off an expense as I go. Okay. Remember, we set up the premium on bond payable as a credit for the 3,600. So how do we reduce it? If it's sitting as a credit, I need to debit in order to reduce. So I'm going to debit premium on bond payable, $900. And then what am I paying out? I have to pay out the interest of $6,000. Because in this example, I'm paying 12% instead of the 8. So keep in mind that when you're trying to calculate how much money I'm paying out for the interest, only calculate the interest part. Look at what the face value is and what the stated rate is. Multiply that, and then if it's 2 payments a year, divide, by 2. So it doesn't matter if it's par value, premium, or discount. If I need to know what that cash is that's going to go out, that's how I calculate. So I know my cash credit is going to be the full $6,000 because I have to pay that out. So I actually have to have that cash, but my expense is not going to be the full $6,000 because I got a little money extra up front. And so I'm going to use that money over the life of the bonds to reduce my interest expense. Does that make sense? So a lot of people have a hard time with bonds. Those are the 3: par value, premium, and discount. Now, once I'm finished paying out the interest, and I go through, it's not bringing up my, I think I have an image on there and it's not bringing it up. So It's basically the same thing. I have an unamortized amount of 3,600 that's sitting on my books as a credit. Each time I make an interest payment, I'm going to reduce that premium on the bond payable by the $900. So the same thing's gonna happen. That 3,600 will dwindle away. And in the end, on my balance sheet will only be the bonds payable at 100,000. It won't have to add anything in the end. It'll just be 100,000. So after I make the first payment of interest, the carrying value will no longer be 103,006. It's not going to be that number because I've reduced the premium by 900. So it's now 2,700 is the balance. So what happens is I have 100,000 plus 2,700. So at the end of June of the first year, when I'm looking at the balance sheet, my carrying value is only going to be 102,700. It's not going to be the 103.6. So you see how that works? Over time, as I'm getting rid of that premium, that extra money that I received, I'm going to be chipping away to bring it back down to 100. On the discount, it's lower, so over time, it's going to continue to rise because I'm reducing the discount. So in the end, you have 100. When I do the payment out, I go back to this entry. When you pay the bond at maturity, same exact entry. I'm getting rid of the bonds payable for 100,000, so I'm debiting. Paying out cash, so I credit cash 100,000. So at maturity, when I pay the bond back, all three examples, it's the exact same. All right, so that is the bonds. And then we have the long-term notes payable. So that's like an installment loan. So think about maybe a car that's over, remember the long-term has to be over 1 year. Think about a large loan maybe that you receive from the bank and you're making payments on that, a mortgage. So what are you doing on that payment? So think about your car payment. What are you doing? You're paying not only principal, but what? You buy a house, now paying principal, you're paying interest. So it's just an installment note. You usually have a payment, a set payment. And portion of the payment, when you make it, goes to interest, and the other part goes to your principal and reduces your balance down. So that's what a long-term notes payable is. It's something that's over 12 months. And I don't know why it's doing this. I know that I have an image here. I wonder, no, I can't disconnect because I'll lose Zoom. Well, we'll go through an example on, let me see if hang on, let me see if I get out and then back in. What happens? So those pictures you see on there with the drawings, that's not me. It's my daughter. She likes to use my computer and play on the whiteboard and draw dresses, and she thinks she's a designer. All right, let's see what happens. Nope. For some reason, it's not bringing them in. Let me see if I can get it to open on PowerPoint, because I do have that example in the PowerPoint. So y'all go back and look at the PowerPoints at all? Yeah? Too far. This is, I think, the appendix. Here we go. Okay, so on January 1, we have Fog Hog borrowed $60,000 from a bank to purchase equipment. He signed an 8% installment note requiring 3 annual payments of principal plus interest. So in this example, they give you tables that you have to look up to figure out what the payment's going to be. You're not going to have to do that for the loans. I'm just going to tell you what the payment is, and then you're going to have to do the entry. But what I want you to see is the entry that we make to put it on the books. So when we borrow the money, we're going to put a debit to cash for $60,000 because we're receiving cash. And then the credit is going to be notes payable for $60,000. Okay, we don't calculate anything with interest until we make those payments, and we calculate how much the interest is based on the balance. But that is the entry when you borrow the money. Okay, so then you can see here that we're making payments of $23,282 is what the total payment's going to be. A portion of that is going to be the interest, and a portion of that's going to be your principal. And so it tells you the interest expense is 8%. So if you do the 60,000 times 8%, I'm making one payment for the year. So I don't have to worry about, you know, dividing it up by the months and then multiplying it back by the months. It's the whole year. So that 60,000 times the 8% is 4,800. So out of the 23,282 that I'm paying, 4,800 of it has to go to interest. The difference goes to principal to reduce the balance of 60,000. So in that column on the end, it says ending balance. That's the 60,000 minus the 18,482, which is going to principal. So the next year, when I make my payment, then I have to calculate my interest. I don't use the 60,000 because that's not my balance. I'm going to use the 41,518 multiplied by the 8%. So now I have an interest payment that's less because my balance is less. So I use that amount as my interest amount. Then my difference between my payment, which is exactly the same as the previous year, 23,282. I deduct 3321 interest payment, and the difference goes to principal. So then I will reduce the 41,518 by the principal only, and my new balance is 21,557. So the final year, I use that number to calculate the interest, times it by 8%. So now my interest portion is only 1725. So I pay 1725 in interest, the difference goes to principal, and then at the end, my balance is 0. Okay, so you see how that works, right? We have a higher balance and we pay more interest in the beginning. Okay, so let's look at the journal entry. So they're showing you all 3 years. So the first year, when I make the payment, the interest is going to go to interest expense. So I'm debiting interest expense 4,800. The difference, which is my principal, needs to reduce that notes payable. So if it's sitting on my books, the 60,000 sitting on my books as a credit from that initial entry that I brought in the loan, right? So now I need to reduce it. So I do a debit. So I'm debiting notes payable for the 18,482, which is the principal amount. I credit cash for the full amount of the payment, 23,282. So it's just showing you what happens each year. Each year, the entry is the same, it's just the numbers change a little bit between the principal and the interest. So in the end, that principal amount, that notes payable that's getting debited each year, will bring that down to 0, and then you will have no more notes payable. on your books. Okay. No, I can't find this. All right, so then here's your formula to write down for this week. It's the debt to equity ratio. And the formula is just total liabilities over your total equity. So again, investors are looking for a way to see if you can repay the loan. And this is one of the formulas that they'll use in determining that risk of investing with you and your company. Let's look at number 1 on the homework. Oh, it's on out. Let me log back into it. Okay, so we're going to look at number 1. Okay, it says Tano issues bonds with a par value of 85,000 on January 1, 2018. The bond's annual contract rate is 8%. The interest is paid semi-annual on June 30th and December 31. The bond matures in 3 years. The annual market rate at the date of issuance is 10%. So the market rate is higher than the contract rate. So what does that mean? We're selling it at a premium or a discount? If the market, if we're paying the 8% and the market is 10%, we have to sell it at a discount because we're paying.
Oh, yeah. Okay.
Okay.
Yeah,
All right.
I got it. I was looking at it wrong.
Okay, so it's telling us that the bonds are sold for $80,684. So they're telling us how much it is. They're not giving us a percentage. They're not telling us to look it up on a table. It's the 684 is what we're selling it for. So it's saying, what is the amount of the discount of the bond? Okay, so what's the face value? 85,000. How much do we sell it for? 86.84. So the difference is the discount. 43.16. So all you're doing is subtracting. So then it wants to know what's the total bond interest that will be recognized over the life of the bond. So it's telling us we have 2 payments for 3 years. So we have 6 payments. All right, so it's going to give you a table to put all your information in. How many payments? 6. Why? 2 per year, and it's 3-year bonds. So what are my payments going to be? It's saying that the payment is going to be $3,400 each time. So I have to calculate that out. It should tell you at the bottom. So you're going to do your, it's not showing you how it did it. It's taken that 8%, I think it's 8% contract rate, yeah. It's multiplying it by the face value, the 85,000. Here it is, right? It's down here. So you take the 85,000 times the 8%, and now how many times a year are we paying that? Twice a year. So we're going to multiply by a half. I'm going to blow it up so you can see it. Right? So we have 2 payments per year. So we want to divide it by 2. So my payment is going to be $3,400 each time I make a payment. How many payments are we making? We're making 6 payments. So 6 times the 3,400 is going to be your 20,400. So that's what's going to be paid out in interest over the life of the bonds until it's mature.
Where does the half come from?
So we are paying 2 payments. It tells me that I'm making payments on June 30th and on December 31. So I have to multiply by a half or divide by 2, because when I calculate out the interest, 85,000 times 8%, that's going to give me an annual amount. And I don't want to put the annual amount. I only want to put what I'm going to be paying at June 30th. And since I have 2 payments, you want to divide by 2.
Gotcha.
Okay, par value at maturity. So remember, when we pay back the loan at maturity, it doesn't matter if we sold it for par value, if we sold it at a premium, or if we sold it at a discount. What are we paying back out? We're paying the par value, and it told us the par value was the 85,000. So at maturity, that's what it's going to be. How much do we repay? Well, we're repaying cash-wise. We're repaying them the interest 6 times, because we have 6 payments. So that's the 20,004. Plus, we're also paying back the amount of money that's on the face value, which is 85,000. So you're just adding those together to come up with the actual amount that you're paying out. So we're paying out 105,400. And what did we borrow? Well, what did we get when we sold the bonds? They tell us that we got 80,684. That difference is what gets expensed over the life of the bonds. So remember, we have the interest payment, and we'll have a little more because we also have to expense a portion of that discount. The discount was 43.16. So we're doing this through straight line. We have 6 payments total. So the 43.16 is going to get divided by 6. And that tells me how much I'm going to expense in addition to my interest each time, because I didn't get that money. And since I didn't get that money because it was short, I'm going to expense it over the life of the bonds. Okay, so number 3 says prepare an amortization schedule using straight line method to amortize the discount of the bonds. That's what I was just saying. So now we're going to look at it on a table and say, okay, this is the total amount that I need to amortize over the life of the bonds. I have 6 total payments. I'm doing it straight line, which means I'm doing it evenly. So I'm divided by 6, and I'm going to do it in a table to show how much it's being reduced each time I have a payment. Okay, so what is unamortized on the day that I sell the bonds? The full amount of the discount, 43.16. The carrying value, remember, is less because I'm showing the bonds at 85,000 less the discount. The discount was 43.16. So my carrying value is what I received in cash, 80,684. Now, as we go and we expense a portion of that discount, it's going to cause my carrying value to go up over the period of time, all the way until maturity, which then I'll have face value in the end, because I'm going to be expensing a portion of that discount as I go, and it's going to be less and less that I'm deducting from that 85,000 on my balance sheet. It's going to show my carrying value going up each time I make a payment. Okay, so on 6/30/2018, I need to figure out how much is my interest. Now, they're not showing you this on the table, but I need to know what to reduce it by. So what is 43.16 divided by 6 payments? I think it shows you on here. Number 3, 43.16 divided by 6 is $719. So every time I make a payment of the interest to the investors, I'm also going to expense $719. Now, we're not looking at the journal entry part, but that's what's happening. We're going to be expensing a portion, right? So it's $719. what happens on my table that I'm filling out is that unamortized amount of 4316 is going to get reduced each time I make a payment by the 700 and I forget what it was now, 19. So at 4316, let me check it, but it should be the 4316 less the 719. So that's my balance of 3597.
How did you figure out the 719?
Okay, so the difference between what we actually collected and what we have as a par value was 4316. That was how much the discount was. So that 4316, I want to reduce it over the life of the bond. And I'm going to do it every time I make an interest payment. It tells me that I'm making 2 payments per year and it's 3 years. So I know that I'm going to be making 6 payments over the life of the bond. So I'm going to take the 4316 and divide it by 6 to tell me how much is my portion each time I make a payment that I'm going to have to expense. So we have 4316 divided by 6 gives me 719. So when I reduce the 4316 by the 719, that gives me the 3597. So on the carry, you got it?
Yeah, I got it. Thank you.
Okay, so on the carrying value side, remember that as I do this, the carrying value is going to go up. I sold it at a discount of 80,684. So we have to remember, think about what it's happened on the balance sheet. This might help you realize what's happening. So I have a note, bonds payable of 85,000. I'm showing less the discount on bonds payable of the full amount at first. It's the 4316. So my net is the 80,684. This is my carrying value when I sold it. So after I make my first payment on June 30th, 2018, when I run my financial statements on June 30th of 2018 and I look at the balance sheet, I'm not going to see this because this number changed. So I now have the bonds payable at 85,000. I'm going to have less the discount. And it's not going to be 4316. It's going to be less the 719 because I just expensed a portion of it. So now it's going to be 3597. So I take the 85,000 less the 3597, and I should get 81,403. This is my new carrying value at June 30th of 18. So you see what's happening is each time we make a payment of interest, we are expensing a portion of the discount. So I'm reducing the unamortized discount amount. That's that discount on bonds payable account. That's the unamortized, the full amount. As we go, that's called amortizing over the period of the life of the bonds. So the carrying value is going to change because that discount account is changing by the amount of the amortization, which is $719. So as I go through, remember discounts, the carrying value is going to go up to the face value. So as you're going through your table, you're going to be reducing this column here, the unamortized discount, because it's not going to be unamortized any longer, right? As we expense it, it's being amortized. So the portion that's unamortized will reduce as you're amortizing. The carrying value is going to increase, and this is why right here. Because the discount, the less discount on bonds payable account is getting smaller and smaller. So the amount that I'm taking away from my face value is getting smaller and smaller, which means my carrying value is increasing. So this is going to increase over the life of the bonds, and your unamortized is going to reduce. So in the end, on 12/31/2020, now you have your maturity and you're left with bonds payable for the face value of the bonds. So when I make a payment, what's going to happen? Debit notes payable 85,000, credit cash 85,000. So I'm paying back 85,000 even though I only collected 80,684. I've also had to pay interest along the way. We just calculated that out. So on this one, it's showing $3,400 each time I make an interest payment. That's the cash going out. So what happens with that? That's part of what I'm expensing, right? Are y'all following so far? If you look at this table here, it shows you your interest. So I have on my pen. Okay, so here's my interest of 20,400. So if I sold this at par value, the only thing I'm paying out is interest. And then in the end, I'm gonna pay back the 85,000. I've received 85,000, I'm paying out the 85,000. So the only interest expense is the interest. In this case, I didn't receive all the money up front. I only received 80,000. So what happens? I have more now in expense than if I would have gotten par value, because I not only have this interest that I'm paying out, I also have the money that I didn't collect, which was how much? 43.16, I think. So we have the interest plus the 43.16. So if you look at this number here, the 24,716, it's telling you what your total expense is. So if you think about it, it should be the interest plus what the money was that you didn't get, because you're going to be expensing that over a period of time. So the 43.16 plus the 20,004 is that 24,716. This amount here. Because not only on a discount am I expensing my interest, I'm also expensing the discount. So remember on the whiteboard, I was saying interest plus the discount is what we're going to expense on our journal entry. That's why, because I have that money that I didn't collect and I need to expense it over the life of the bonds. Does that make sense? Y'all have any questions on that one? Okay, I think the next one, number 3, I think might be the same thing, but as a premium. Okay, so we have Quattro Company issues bonds dated January 1, 2018 with a par value of 770,000. The bond's annual contract rate is 12%, and the interest is paid semi-annually on June 30th and December 31. The bonds mature in 3 years. The annual market rate is 10%. So I'm paying out 12%, but the market rate is 10%. So that means I'm selling it for a premium. Okay, and the bonds are sold at 809,071. Again, it's telling you how much it was sold for. Notice we're getting more money than what the face value was. So now we're going to do the opposite. We're going to reduce our interest expense as we go through the life of the bond. Okay, so first we have to say, what was the premium? How much did we sell it over face value? So you're just subtracting. The 770 is what the face value is. And then we have the money that we actually received, which is 809,071. So you take the difference, the premium is 39,071. So that premium is going to reduce my interest. And I'll show you at the end, like we just did. Whoops. Okay, so let's look at number 2. Let's put it in our table. So again, we have 2 payments per year, 3 years. So we have 6 payments in total. What payments are we making? We have to calculate out our interest. How much was the face value? Don't use what you received when you're calculating out the interest. That's the other thing. Don't use the amount that you received. Always use the face value or your par value. It tells us the par value is $770,000 and that it's paying 12%. So when you calculate that out, you have to divide by 2 because we're making 2 payments. All right, so it's showing you down here 770 times the 12% times a half gives you 46.2. So every time I make an interest payment, that's how much I'm paying, 46,200. I have to pay that in cash. Now, what I expense is going to be different in my interest. So remember, I have a little money that I collected in advance. So I'm going to divide that up and I'm going to reduce that expense as I go. But we'll look at that. We'll look at that on the next table. Okay, so we have payments of 46.2, multiply it by 6 because I'm going to make 6 payments. It's going to come to 277,200. So that's what I'm paying out in cash. The par value at maturity is going to be the 770. How much did I receive? Less the amount that was borrowed. Well, I received more than the face value. So it's that 809,071. And when I reduce it, it tells me my bond interest expense is 238,129. Now notice what's getting expensed at interest is lower than what the interest payments were. You see that? And it should be lower by the premium amount. So if we take the interest we're paying is 277,200, and let's look at the premium. It was 39,071. So if we deduct 39,071, my interest expense should be 238,129. And when you look at this table, it's telling you your interest over time is going to be 238,129. So you see how if you sell it and you get that little bit of extra cash in the beginning, it reduces your expense. If you sell it for less, then you have to take that money and add it to your expense.
How do you get the less amount borrowed?
Okay, that is the amount. The less amount borrowed is the amount the amount that you're borrowing is the cash that you received. So you sold these at a premium, and it told us in the problem that the bonds were sold for 809,071. That's the cash we received. So that's what we borrowed from the investors, 809,071. And that's why we deducted it.
Oh, okay, I got it.
Yeah, so on the other one, the less amount borrowed was actually less than what the face value was because we received a little less. So it's just whatever you received in cash. What you received in cash is what you borrowed. Okay, so let's look at our table for the amortization of the premium. So we start with the total premium of 39,071 and our carrying value of 809,071. Remember, that's what we received. And so again, if you're looking at the balance sheet, you're going to have your bonds payable of 770,000. And what do we do for premiums? We have to add. So we say plus the premium on bonds of 39,071. So my carrying value is 809,071. And that's what it should be because that's what I received in cash. Now, as we amortize the 39,071, the premium, that amount is going to be reduced. And if it's reduced, then I'm adding less and less to the 770, which means the carrying value is now going to decrease. So remember, on discounts, it increases as you go up to the face value. And on the premium, it's going to decrease down to the face value. So if you don't fully understand what's happening, just remember that your carrying value is going to increase over time with a discount and it's going to decrease over time with a premium. All right, so we have the 39,071, and we want to amortize it straight line over the life of the bonds. How many payments are we making out? 2 per year, 3 years, so we're making 6 payments. 39,071 divided by 6 is 6511.8333. Let me see what they have that they want you to use. It's saying to the nearest dollar, so it should be 6512. Yep. So if you look at number 3, straight line amortization says 39,071 divided by 6. It's 6512. So as I amortize, I'm going to reduce the unamortized because it's not going to be unamortized any longer because I'm going to amortize it, a little piece of it each time I make a payment. So on 6/30, the 39,000 is going to be reduced by that 6512. So I'll do 39,071 minus, I don't remember what the amount was now. 69, what was it, 6512? 6512. So then my balance is 32,559. The next payment, when I make on 12/31, it's going to be reduced again by the 6512. You see what's happening? So my balance is 26,047. On the carrying value side, it's going to increase. Let's see if I can write it here. So on June 30th, my balance sheet's going to show bonds payable 770. That number never changes, plus the premium on bonds discount, bonds payable. And instead of being this 39,071, it's going to be reduced by the 6512. So now it's only going to be 32,559. So I add that to the 770 to get my carrying value. So my carrying value becomes 802,559. So you see how it reduces the carrying value? It's because this account is reducing right here, the premium on bonds discount. Think about the journal entry. Normally, when you start with a premium, you have a credit in the premium on bonds discount. And so as you go, you're going to be debiting, which means that account is decreasing. So the amount that you're adding to the face value is less and less and less as you go. All right, so that's a premium. Let's do number 7. Okay. So we have on January 1, 2018, Company borrows $320,000 cash from a bank and in return signs an 8% installment note for 5 annual payments of $81.46 each, with the first payment due 1 year after the note signed. So I'm making 1 payment per year. It's given me the amount. So it's just like the example we looked at when I did the lecture. It's going to be that payment, and we calculate the interest and we back into the principal. Okay, so it says prepare the journal entry for the issuance of the note. So what happens if I borrow money? You get what? Borrow money from the bank. What do I get? Not a trick question. Cash. All right, so I'm borrowing $320,000. I'm getting cash. So my entry has to be debit cash, $320,000, and then I'm going to credit notes payable, $320,000. That's it. I'm just putting it on the book saying I got money and now I'm liable to pay somebody that money back in the future. So now it says for the first $80,146 annual payment at December 31, 2018, what amount goes towards interest expense? What amount goes towards the principal? So remember, they gave me the payment, so I know how much my payment's going to be. It's that 80,146. So how do we calculate the interest for the year? We take the 320,000 and my percent is 8%. So I do the 320,000 times the annual rate of 8%, and that gives me 25.6. So my interest is 25.6. I'm just multiplying it by the interest rate. Remember, it's all 12 months, so we don't have to figure out what the portion is for a period of time. It's for the whole year. And then we have the principal, which is the difference between what we pay in interest and what we pay in as a total payment. So you just subtract the 80,146 less the interest expense. Okay. So we have Enviro Company issues 10% 10-year bonds with a par value of 380,000 and semi-annual interest payments. On the issue date, the annual market rate for these bonds is 12%, which implies selling of 88 and one half. So the 12% market rate is higher than what we're issuing. We're stating that we're going to pay in interest. So since the market rate's higher, we're selling at a discount. The reason why I wanted to show you this problem is because sometimes you have to look up the amounts on the tables, and I wanted to show you how to do that. So when you're looking at the table that they have down here and you have to fill it in. Oh, can't get it to move. Okay, so we have the par value 380,000 times the price of 88.5. That gives me my selling price of 336.3. So my maturity par value maturity rate bonds is going to be 380,000 for the value, and then it has my table value. So you have to know how to look that up. So you're gonna have to click on table B1 for this section here, and when it comes up, you need to know what to look for. So it's telling me that I have a 10-year bond at 10% is what I'm paying. And it's for, tell me how long, 10 years, 10%. And then let me go to B1. Okay, so the rate is the 0.3118. So we're looking at 6%. So remember, the annual interest rate of the market is showing 12%. So you want to take half of that, right? Because you're making two payments. They're telling us we're making semi-annual payments. So you divide it by 2. So you have 6% over the course of 20 payments. So remember, it's 2 payments for 10 years. So that's 20 payments. You see, can you see that on the table? It's right here. So for that first one, I need to use the table B1, and you want to look at the market rate. It's semi-annual payments on this example, so you would divide by 2. So my interest is 6%, and you look to see how many payments. It's going to be 20, and you can find your rate. All right, and then for the second one, for your interest payment, you need to look for the number on table B3. See if I can get it into the spot. No. It won't let me move. All right, so I'm looking at 6%. And this 20 right here. So here's my number. 11.4699. So that's the number that I would use to fill in my table. Bless you. All right. So it's saying that the table values to the 4 decimal places is how it wants it on the table. So if something happens when you're calculating it out, I would just adjust your number slightly and see if that's why you're getting a wrong answer. Okay, so we have 380,000 as our par value, our face value of this bond. And then it says that we're paying out interest of 10%. And we have how many payments per year? 2. So we would divide by 2. So that on the side here where it says 19,000 interest payment, that's where that's coming from. Taking the par value times your stated rate that you're going to pay, divided by 2 because you're going to have 2 payments for the year. So the interest for the payment is the 19,000. You multiply that by your number that you found on the table, and that gives you your 217,928. So it rounded it up. So if the table has more than 4 numbers, just use the 4 numbers. Do the same thing for the maturity date, times it by the 0.3118. It gives you the 118,484. And so it's telling you the price of the bond is the 336,412. And the difference of the rounding from the tables versus using that 88.5 is only $112. Okay, so now we want to prepare a journal entry for the issuance of the bonds. And we're going to assume the bonds are issued on January 1, and we receive cash. So on January 1, the cash coming in is $336,300. Remember, the base value is $380,000. That market rate was higher, so we have a discount. So we're going to have to debit the discount on bonds payable account, the difference between what we got and what the par value was. So the difference was $43,700. Okay, so you see how to calculate this. So they didn't give us the amount that you received. You had to figure that out. We took the 380,000 times the 88.5 to calculate that out, which is the 336,300. And then that's what we use in the journal entry. Okay, so remember for the tables, you're going to use B1 for the first one and B3 for the second one. The market rate divided by 2, and then the payments, 10 payments multiplied by 2. I think number 11 is the same. Let me just make sure. Oh, no, it's different. Okay, so this is something that happens when they decide that they're going to call a bond early. So on July 1, Advocate Company exercises a $7,200 call option plus par value on all the outstanding bonds that have a carrying value of $371,000. The par value is $360,000. The company exercises the call option after the semi-annual interest is paid the day before on June 30th. Okay, so it's telling us what the carrying value is, and it's telling us the par value. So there's a couple of things we know that we can put into our journal entry, right? So we're telling them, we're not only going to give you that par value, but we're going to incentivize you, and we're going to call those and give you some extra money. So they're saying they're going to pay them $7,200. So they're going to pay not only the face value, but also the $7,200. So do $7,200 plus the $360, the $367,200. That's what we're willing to pay out. So that's going to be my cash that goes out. When my cash goes out, I know that's my credit. So you see where we calculate and how much we're paying them. We're not only paying them the par value, but we're also paying them the call option, $7,200. So we're just adding them together. So I know my cash. I know my face value, $360,000. How does the bond normally sit on the books? As a credit. Bonds payable for $360,000. It's going to sit until maturity. Well, I'm calling these early, and so I'm pushing the maturity date up. So I want to get rid of that. I get rid of that by debiting bonds payable for the face value, because that's what's in that account right now, $360,000. So I know that that's my debit. And then I have to clear off the premium that's left on the bonds payable. So remember, I have a difference between the carrying value and the par value. So the par value is only $360, but my carrying value is $371. So remember, when the carrying value is higher, that's a premium, because it's going to decrease over time. The discount's when it's going to increase over time. So I know I have a premium because my carrying value is higher than the par value. So I need to take the difference between the carrying value and the par value, which is 11,000, because it's just the 371 less the 360. So I have 11,000, and I need to clear that account. And what's left in there is the 11,000, and it's sitting as a credit, because when we put the when we issue the bonds, we put that first journal entry on the books, the premium is a credit. So how do I get rid of it? I have to do the opposite. So I'm going to debit the premium on bonds payable, 11,000, to get rid of it. So when you do all that, you have a difference there. Your journal entry does not balance. So if you figure out what the difference is, so on my debit side, I have the carrying value of 371. And then on the cash side, I paid out 367 too. So I didn't pay out the entire 371. I saved a little bit of money. So that difference is considered a gain. So what's income normally? A credit or a debit? Income is usually a credit. So when we record the gain, we record a credit. So we have a gain on retirement of bonds of $3,800. So it's the difference between what we're actually paying out in cash and what the carrying value is. Now, if we had a loss, where would a loss go? Not as credit, it would go as a debit, because it would reduce your income. Okay, so do y'all have any questions about any of that? Okay, the last question is just telling me the advantages and disadvantages, what we went over that earlier. Okay,